Hello and welcome to the webinar for the Solder Brothers Emerging Companies Limited Fund, which is ASX code SB2. We've moved from a monthly webinar series through to a quarterly, just so we can give a more complete picture of what's going on within the fund and within the market. And we thought we'd take the opportunity today to focus on the year in review and a bit of an outlook for 2026, and then a bit of an update on the portfolio itself. So again, probably not going to be an opportunity for Q&A in this forum today, but following receipt of this recording, if you have any questions, please do feel free to reach out to myself or a member of the team for further discussion. And another pleasing thing is we're planning a national roadshow during the month of March, where you'll shortly be receiving an invitation to join a group session. And there's also the opportunity for one-on-one meetings in each of the key capital cities during the month of March. So please keep an eye out for that. But I'll turn over now to the executive summary and provide the update. But so on, Kat, if you could kindly forward over the slide, please. Look, we've got some updated numbers on Solder Brothers here. Now managing over $10.3 billion across its various business lines. And that gives a bit of a breakdown of the various pools of those assets. And again, we talk about that being spread across the property sector, equities and credit. Today we're here on one of the key equity products, which is the Solder Brothers Emerging Companies Fund, which is a listed investment company listed on the ASX under the code SB2. And remember, the mandate for this fund is investing in small cap Australian companies with a market capitalisation of under 500 million. So very much a micro cap blended fund. The fund now has coming on near a 5-year track record, but we've continued to provide consistent long-term outperformance, which is very pleasing. I'll talk about it further today, but as at the 30th of January, the share price of SB2 does trade at a discount, and it traded at a 27% discount. What I'll talk to today is that there has been a bit of a sell-off in the market over the month of February, though the underlying SB2 portfolio continues to trade quite well. And so that discount has only widened over the course of February. So the opportunities are very significant. So if we jump over the slide, I'll start with a bit of an overview of the 2025 year, the key thematics and outcomes, and how that shapes our view on the portfolio and the outlook for 2026. Like most years, 2025 was a mixed year with broadly positive outcomes on both the economy and the financial markets, but there was great disparity between equity market performances, both domestic and international, large cap and small cap, industrials and resources. So I guess the pleasing thing was that Australian and more small and micro cap sector did outperform the large caps over 2025, and also outperform their international peers. But a key driver of that outperformance was the resource sector. To put into perspective, the resource sector, depending on what index and you look at, but delivered closer to 50%, and in some instances higher than 50% returns over 2025, whereas there was sectors in the industrial sector that were under either negative performance or single-digit positive performance. So definitely resource was the shining star, the resource sector, and which shows I think it's encouraging, because that shows the risk appetite is starting to return, and just shows the great return opportunities that can be found in the micro cap end of the market when the stars do align. And we continue to think the stars are broadly aligned for continued positive performance. We actually released, on our website and on our social channels, a detailed review of the 25-year and the outlook. And so there's a lot more detail in there in that research piece, which is a 6 to 8 page research piece that I encourage you to have a look at, where we do a deep dive into the significant divergence of performance in the various sectors and stocks that I referenced earlier, and more so highlighted in the small micro cap end of the industrial sector in the ASX. And what that analysis shows is that at a stock level, the top quartile performing stocks delivered 30 and 50% annual returns, and the bottom quartile delivered that again on the downside. So stock selection, more than ever in the current market environment, is critical. And so, while there's a debate around whether active management has its place in large cap, equities, both domestically and globally, the data, overwhelmingly points to active management has an opportunity to add significant value in the Australian market. And that's what we do. That's what the SB2 fund does. It focuses on that end of the market, and now we continue to deliver positive performance relative to our industrial benchmark. And just highlighting for those who are relatively new to the story that we do not invest into resource companies, so we didn't participate in that strong performance in FY or calendar year 25, but despite that, still delivered positive performance for our investors, and outperformed the industrial microcap benchmarks. I guess very relevantly, the outlook for 2026 continues to be positive for microcaps. And look, the research report we released was completed in January, and there's 2 weeks is a very long time in financial markets, as we all learn, and there's been a lot of volatility even over the month of February. And highlighting some of that volatility is that the disparity of performance just over the month between large caps and small caps has been about 10%, actually in favour of large caps. So large caps have outperformed, while there's been a bit of a risk-off trade in the market over the month of February. So the dynamics I speak to are only further amplified as we roll into the 2026 year. But our view is that the significant outperformance and relative outperformance of the resource sector versus the industrial sector, that is not sustainable. And we believe there'll be some mean reversion, and the risk versus reward trade-off of investing in the resource sector versus the industrial sector is at pretty extreme levels, meaning it's hard to identify a significant upside in the resource sector at current levels after a 50% plus positive performance over the 12 months. And there is opportunity for meaningful downside as it gets back to more normalised levels of multiples and valuations in the resource sector. Conversely to that, the industrial sector that didn't have that supercharged growth is now trading at a even more amplified discount to the resource sector and the large cap sector as well. So our view for 26 is that we really do believe that there'll be some catch up for the industrial sector in the small cap end of the market, and I think that bodes well for the fund and our portfolio positions. The other interesting dynamic is that over 2025, the industrial stocks that did perform well were more traditional value style stocks, and again, they're probably getting more appropriately valued at a sector level versus some of the more growth oriented stocks. So in summary, lots of opportunity as we roll into 2026. February has been a very volatile month in markets, which creates further opportunities, and we're actively deploying capital in the market over the month of February quite opportunistically. All right, I'll jump over the slide now and talk a little bit about more specifically. It's just a graphical representation of the disparity of returns over the 2025 year. So you can see the top line is the resource sector, and then some of the bottom lines are the various subsectors of the industrial market. So small and large cap industrial and resource. But what's super clear is those top two lines are the large cap or small and large cap resource sectors, and the bottom lines are sort of the large cap and small cap industrial sectors. So it really highlights the significant diversion of performance, which we're basically calling out. We think will revert and potentially invert over the course of 2026, and think that small cap industrials is a good place to be for the next 12 months. So we jump over to the slide now, and we'll talk about a few of the components. Now, this is going to be very topical for our portfolio over the course of the next 3 months. And I have flagged this on multiple occasions, and that is that at the moment, the portfolio has approximately 17% of the holdings are in unlisted investments. So they're in equity investments in companies not listed on the ASX. I've spoken about this process to exit a number of these investments and reduce that component down to a lot less than 10% and potentially closer to 5%. And this, I think this will be quite a significant delta for the company, because in the event we do exit these companies, we're confident about doing so at valuations north of their current holding value in the fund. So not only does it unlock cash and increases the NTA, I think it creates a real arbitrage for investors to keep an eye on. So a couple of the unlisted holdings we've spoken to, IPSI, a fintech business that we've publicly disclosed is going through a sale process. That's coming to the final end of completion, and now looking to have an update for investors by the end of this month in relation to that. But in the event that all completes as expected and the funds flow from that, it'd be a very favourable outcome for the fund and our investors. A couple of other investments here. Another fintech business called Sphere for Good. That's also gone through a exit process and has been acquired by an ASX listed company, which has been publicly disclosed by that company, which is Findi, FND. So that will move from a unlisted holding to a listed holding in our portfolio as we roll into the next month of reporting. And then the second one there on the list is a business and asset management software business called Pelican Corp. Again, in the very final stages of a potential exit transaction, and there's been significant interest in that asset, and we look forward to updating investors over the next few weeks in relation to an outcome in that company as well. So if we jump over the slide, it's again a graphical representation of this unlisted portion. So as you can see there, it shows that 17% of the portfolio is in unlisted. In the event we were to sell these assets, obviously the proceeds would become cash, and so you would see a reduction in the unlisted portion and an increase in cash, which again gives us firepower for a potential special distribution or an increased dividend, but also gives us further firepower to reinvest into what we believe is a very opportunistic listed market at the moment. And we spoke about the mix of these investments, and as you can see, the ones that we're speaking about that we're looking to exit represent the majority of the unlisted portion of the portfolio. So IPSI and Pelican combined are 70% of that 17% slice. So in the event we successfully exited those businesses, you'd see a dramatic reduction in the unlisted portion. There is a genuine opportunity where we can exit those investments at a significant premium to their carrying value, and so effectively, there could be anywhere between 50 to 100% upside in the current valuation. So, which would be really positive contributor to performance. So, please keep an eye out for that. At appropriate times we'll release to the market any developments on those, but continue to reiterate it's a significant and genuine opportunity, and a potential positive catalyst for the portfolio in the near term. If we jump over to the next slide, we'll talk about it's a consistent slide that we have in every update, is just the key top 5 holdings in the listed portfolio, and then what the metrics of the combined listed portfolio are. And again, there hasn't been a significant change in the mix of the top holdings, and they continue to perform quite well. So we've over the course of 25, most of these top 5 holdings were significant contributors to our performance, and we think the opportunity for them to continue to do that in 26 is significant. We have trimmed a number of those positions over the last 6 months, but we think there's some really interesting upside there. We are currently in what we refer to as reporting season. All the listed companies are releasing their 6-month financial results through to the December month end, and so there'll be a lot of news flow on the listed companies and these key holdings in the next 2 weeks, effectively. And so we think there's some real catalysts within these names. And what I would point to is, one of these here, which we've spoken about in the past, is AI Media, which is a software business that sort of does live voice captioning. I actually attended a global conference for AI Media last week in the US. I was the only attendee from the investment markets, full stop. So there was not a single investor or broker at that conference, with the exception of myself. And that's the sort of research and work that we do on these companies to get that competitive advantage, from the broader market, to understand how the businesses are performing, what are the key drivers, and what are their customers thinking with respect to their technology. So it was a great forum. Again, got to meet with a number of their key customers and really understand the use cases and how they're thinking about voice and text translation in live media over the next 3 to 5 years, and really cemented our conviction in the role that AI media does play and will increasingly play in that sector at a very global level. Like, some of these customers are top 50 American companies such as Disney and Microsoft, and some very significant global customers that are continuing to utilize AI Media's software and grow considerably. I'll talk more about those individual holdings in the next webinar, off the back of the release of their results, but we think there's some good catalysts coming. What I go back to is just the combined metrics of the portfolio. And if you look at the table on the right, as we roll into this year and into next, we've got the weighted average revenue growth of our portfolio is 26%. So that's the companies, you sum together all the companies, and on average they're all growing at 26%, which is pretty remarkable. And the fact that we can compile a portfolio of 25 of these companies at a PE of sort of 10 to 12 times on a forward-looking basis, and an EBITDA, which proves, one, they're profitable businesses, and you go to an EBITDA basis, you're at sort of 6 to 7 times multiples, which is well below historic averages, and which is what drives our conviction on the outlook for the portfolio and the sector over the next 12 months. And then onto the topic of, on the next slide, just around the discount. Again, as of January, it was 27%. The share price was 79 cents at the end of January. As of this morning, it had fallen to 72 cents with the recent sell-off in the equity markets over February. We're pretty confident of delivering good performance during the month of February. That definitely doesn't justify that 10% move, let alone the 20% discount. So my best guess is we're closer to a sort of north of a 30% discount as we speak, and with a positive catalyst coming, I'm increasingly confident that that will close. We spoke about in the event we do get outcomes on the unlisted portfolio, it gives us further cash and firepower for an increased dividend and/or a special dividend. That'll be considered, at the end of this month and communicated over the course of the next few weeks to investors. The other thing I'd point out is that you roll back only 2 years ago, we had a large component of our share register in SB2, the listed investment company, that were sort of unnatural investors, and so we've cleaned up the register, removed that overhang of sellers from closer to 50% to below 10%. So and now that 9% of investors, I'm not aware of any of those looking to sell at the moment. There's obviously natural flow in the market, but that overhang's definitely tightened right up, and so it should trade on fundamentals now. And as I've emphasised today, the fundamentals are looking pretty good. Just point to again that for people wanting to learn a little bit more about the fund and its investment prospects, we have commissioned an independent report on the fund and the investment team and process, and that's available to investors on our website and upon request. And the other thing, again, I touched on at the start of this presentation, in the month of March, I'll be doing a national roadshow, going out meeting investors and advisory groups specifically on SB2, talking about the recent developments and the opportunity it presents from a risk versus reward perspective. So hoping to generate more awareness and demand and buyers in the name off the back of some positive catalysts, which again hopefully all bodes well for a closing of that discount to NTA. All right, well, that was all I had planned to present today, and again, we won't have any Q&A today as a result of a potential technical issue with the webinar, but you'll be watching a recorded version of this. And I encourage, if you have any questions, please reach out to myself or any member of the team at Solder Brothers, and we'd only be too happy to respond, and hopefully can get to see you in person during the course of March as we conduct the National Roadshow. Thanks again for your time and attention, and look forward to continuing the conversation shortly. Thank you and goodbye.